This video will guide you about different types of equity schemes. To make things clear for every investor, SEBI has divided open-ended equity schemes into 13 distinct categories. Taking the first step into these categories, we have the multi-cap fund, which is designed to spread investments across all types of company sizes. For this scheme, at least 75% of the total assets must be kept in equity or related instruments. There is also a very strict rule for how this money is divided. At least 25% must go to large cap companies, another 25% to mid cap companies, and a final 25% to small cap companies. Moving along to a more focused approach, let's look at the large cap fund, which primarily targets the biggest and most stable companies in the market. The regulatory requirement for this fund is quite high, as it must invest a minimum of 80% of its total assets specifically into large cap companies. Expanding on the idea of company size, we find the large and mid cap fund, which allows for a mixture of two different tiers of the market. To ensure a balanced exposure, the rules mandate that at least 35% of the money must be in large cap companies, while another 35% must be kept in mid cap companies at all times. If we want to focus more on the middle tier of the market, we should consider the mid cap fund. This type of fund spends most of its time looking for opportunities in medium-sized businesses and must keep at least 65% of its total assets invested in mid-cap companies. Transitioning from the middle to the smaller side of the market, the small cap fund is next on our list. These funds focus on smaller companies that have a lot of potential for high growth. Just like the previous category, these schemes are required to have at least 65% of their investments in small cap companies, for those who prefer more flexibility in their investment strategy. The Flexi Cap Fund offers a dynamic way to manage money across all market sizes. While it must maintain at least 65% of its assets in equity, the fund manager has the freedom to shift between large cap, mid cap, and small cap stocks, depending on where they see the best opportunities. Shifting our focus from company size to how they reward their shareholders, we come to the Dividend Yield Fund. This scheme mainly looks for stocks that pay out regular dividends to their investors. To follow the rules, at least 80% of the fund's total assets must be invested in equity or equity-related instruments. Another interesting strategy is found in the Value Fund, which follows a specific way of thinking called value investing. This means the fund manager searches for stocks that they believe are undervalued by the market. Similar to other focus strategies, at least 80% of the assets must be kept in equity instruments. Building on the idea of unique strategies, the Contra fund takes a path that is opposite to the current market trends or general opinions. It also requires an 80% minimum investment in equity. A very important point to remember is that a mutual fund company can offer both a value and a contra fund, but the portfolio overlap between what they own cannot be more than 50%. Now let's explore the focused fund, which takes a very concentrated approach by investing in a very small number of stocks. These funds are limited to a maximum of 30 stocks only and must keep 80% of their assets in equity. It is also mandatory for these funds to clearly state where they intend to focus, whether that be in large cap, mid cap, small cap, or multi-cap stocks. If you want to put your money into a specific area of the economy, the sectoral fund is the way to go. These funds invest only in a particular sector, such as banking, IT, or pharma. The regulation here is that at least 80% of the fund's money must stay within that chosen sector. Following a similar path but with a broader view, we have the thematic fund. Instead of just one sector, these funds invest based on a specific theme like infrastructure, consumption, or ESG. A theme can actually be a combination of two or more different sectors, but the fund must still keep 80% of its assets within that theme. For those looking to save on their taxes while they invest, the ELSS or Equity Linked Savings Scheme is a popular choice. This tax saver fund requires at least 80% investment in equity and comes with a lock-in period of 3 years from the day you are given your units. The big advantage here is the tax benefits you receive under Section 80C of the Income Tax Act. To wrap up our look at these equity schemes in this video, there are a few other conditions we should know about, like the residual portion. This refers to the small part of the fund's money that is not in its main core assets and can be put into things like money market instruments, gold, silver, or even NVIs. Also, keep in mind that sectoral or thematic funds from the same company cannot have more than a 50% overlap with other equity schemes, and the list of available themes is updated by AMFI in consultation with SEBI every 6 months.